Good morning. You are again welcome to this channel, and this is the last. This is going to be the last part, last session for this correction of errors. In the first section, we treated correction of errors that will not affect the agreement of the travelers, where we spoke about error of commission, error of commission, compensating error, complete loss of entry, error of original entry, transmission errors. And after that, the second video, we also treated errors that will affect the agreement of the travel balance. Uh, when we spoke about errors that will not allow the totals of the travelers to be equal. And when the totals of the travelers are not equal, then that will lead us into the opening of the account that we call sources account. And that's after that we also use this illustration to explain that error that will affect the agreement of the trial balance. And now we want to end this topic by looking at the effect of errors on reported profits. The effect of errors on reported profit. So I'm going to use the questions, the illustration, the errors that occurred in the last illustration, in the last video, the last session. I'm going to use that and see how to correct the errors on reported profits. So most often, the final account will have been prepared before we will now start solving the errors that occur during the year. So that's why if you look at this, it says the effect of errors on reported profits. Calculate adjusted profit if reported net profit is assumed to be 20,000. So we are asked to calculate adjusted profit. That is after taking into consideration all these errors that occurred during the year. Then we can now adjust the net profit, the reported net profit according to the final account, profit and loss account. Then and we have to arrive at what we call adjusted profits. So let's look at this is we are going to there's no format for this, so that's why it's called statement of adjusted profits. So you can see the solution we have reported profits which is according to the net profit given assumption of 20,000 during the year of net profit. Then there are some errors that when we think about them, we have to add them back to the net profit. That is, those errors, after they are been corrected, they will increase the net profit. And there are some errors, after they are been corrected, they will have the effect of reducing the net profit. Then before we can arrive at our adjusted net profit. So let's quickly take a look at all these errors one after the other. One after the other. So we are starting with number one, which says the purchase value was undercast by 1,000 naira. Now let me say this now. To know whether an error is going to be added back to the net profit or going to be subtracted from the net profit, you must be able to know in which of the accounts or in which of the accounts is this error going to have effect. Now we also know that net profit is arrived at in the profit and loss account. Net profit is arrived at in the profit and loss account. So any error that we have effect that we have effect or that's supposed to be an item that's going to have effect on an item in the trading account or that's going to have effect on an item in the profit and loss account will definitely have effect on the net profit. So I will repeat this again. Any item, any error that's going to have effect on an item that has been included in the trading account or profit and loss account will definitely be we have effect on the reported profit. So it's either we are going to add it or we are going to subtract it. So that is the idea we are using now. So let's take the first one. The purchase value was undercast by 1,000. We can see the purchase, this one is talking about purchases account. And we used to have purchases figure. We used to have purchases in the trading account. Automatically, this first error, is going to have effect on our reported profits. Now, let's look at what kind of effect is it going to have, whether we are going to add that's 1,000 back, and we're going to subtract 1,000 back from the net profits. So let's look at it. Purchases table was undercut. That is, purchases table was reduced mistakenly. Was reduced mistakenly. So which means if you look at purchases here, purchases, we debited purchases in the journal in the last video. We debited purchases in the, which means we increase purchases. We increase purchase figure by 1,000 naira. Now, if we increase purchases figure by 1,000 naira, then what effect is purchases figure in trading account? What effect is purchases having on the sales revenue? If you look at purchases, which means cost of goods purchased, the cost of how much did we spend in purchasing the goods that we sold to realize that sales revenue. So normally in the trading account, purchases and sales, they are as different side. Sales is under the credit side, and while the purchases is at the debit side. And the purchases used to reduce the income. Purchase cost of purchases used to reduce our income. So if we are now saying that purchases was mistakenly reduced, we have to add back 1,000 to purchases, which means we are increasing our cost of purchases. And if we increase our cost of purchases, it means our net profit is supposed to come down. We come down. I hope you are getting this. Let me take this back. Let me take this. Let me repeat this now. Now it says the purchase debit was undercut by 1,000. And this is our purchase figure. The cost of purchases that we put in our trading account are being reduced mistakenly by 1,000, which means we have to increase the figure of purchases that we put in that trading account. And when we increase the figure of purchases that we put in trading account, what is the effect of purchases itself? Purchases itself on the trading and on the sales revenue generated. You can see that the cost of purchases must be subtracted from the sales revenue in order to realize gross profit. So if we now increase the purchases figure, it means it will reduce our sales revenue. So automatically it will reduce our net profit. So for reducing our net profit, it means that figure must be here. You have to subtract it from the losses with our net reported profit, because it must reduce our net reported profit. So undercast, let's undercast of purchases will be here. That is 1,000. I hope you understood this. Let's go to number 2. Commission received 2,000 had been already entered in the account, was posted as 1,300 to the cash flow. Commission received. Now this says number 2 says commission received 3,000 had been already entered in the account. That is, commission received. There was no mistake in the commission received account. This 3,000 naira was already recorded in commission received account, and commission received account was recorded into profit or loss account, which means there was no mistake, there was no error. This error is not affecting trading account, not affecting profit or loss account. So it's not coming into this, it's not going to have effect on the reported profit. It's only affecting the cash book, and cash book is going to appear in the balance sheet. Now, so we are not going to use that number 2 here. Let's look at number 3. It says sales table was overcast by 150. Sales table. Sales is mentioned there, and sales used to appear. It's an item that used to appear in the trading account. It's an item that used to appear in the trading account. Sales. So since it's appearing in the trading account, automatically it's going to be inserted into this. Either we are adding or subtracting to be inserted into this statement. Now let's now think about this sales figure. Sales table was overcast. The sales figure reported in the total account was too much, was overcast, was too much by that figure, by 150, was too much by 150. So which means we have to reduce the sales figure. And when we reduce our sales figure, automatically we are reducing our reported profits. If we should reduce our sales figure, automatically it will automatically reduce our profit also, because sales figure is reduced, which is an income. Reduce automatically net profit also will reduce. So it's also coming there. Let's less overcast of sales 120. 120. Less overcast of sales 120. So the next one is purchases from our 120 were entered in his account but omitted from purchases account. Purchases from Mawa. Purchases from Mawa was entered in his account, which means it was entered in Mawa's account. You can see in his is here is talking about Mawa. So there was no mistake in Mawa's account. And Mawa is transferred to the other personal account. So it's going to appear either as a debtor or as a creditor, but we are not concerned about that now. Purchases from as a creditor. So let's be precise as a creditor. So there was no mistake in Mawa's account, but it was this transaction was omitted from purchases account. Let's now add this to purchases. What's supposed to be added to purchases figure. So if we add it to purchases figure, it means purchases figure will also jack up, also increase. If our cost of purchases also increase, it will reduce our net profit. So it's also coming there. It's also coming there. Omitted, purchases omitted. Purchases omitted. How much is that? That is 120. Okay, the other one was 150. 150, and this is 120. 150, 120. Now let's go to the next one, which says a receipt from Tino of 560 was entered in the cash book but not credited to any account. A receipt from Tino of 560 was entered in the cash book but not credited to any account. Now, a receipt, that is we receive cash from Tino. If we actually receive cash from Tino, it means that cash account is receiving. Then it says was entered in the cash book, which means there was no mistake in the cash book. And cash book is not affecting even the trading account, not affecting, not it's an item, it's not an item in the trading account and not an item in the profit account. Let's consider the second account that is this area is affecting. Was not credited to any account. Supposed to be credited to Tino's account, but Tino also is not an item that will appear in the trading account. It's not an item that will appear in the profit loss account. So this error number 5 will not affect the trading account, will not affect the profit loss account. So it's not going to be included in this statement of adjusted profit. And number 6 is discount received of 280 was entered on the debit side of discount allowed. So discount received is mentioned there, and discount allowed also mentioned there. So we know that discount received and discount allowed are both items that used to appear in the profit and loss account. So automatically we know this is coming in. But let's now consider what has happened and how are we going to, or what are we going to do here. Now, the same discount received of 280 was entered on the debit side of discount allowed. It was entered on the debit side of discount allowed, and discount allowed appeared at the debit side of the profit and loss account. And whereas it's supposed this figure was not supposed to be part of discount allowed, but well, the mistake that had been made, it had been added to discount allowed, and it was already at the debit side of the profit and loss account. And what was the effect? What was the effect when it was at the debit side of profit and loss account? It reduced our profits. So we have to, it has reduced our profits. This error will reduce our profits because it was an expense removed from the profit from our profit. So we have to add this discount allowed back. Discount allowed. Of 280 must be added back. So if we now add it back, if you now add this discount allowed 280 back to our profits will jack up because it was initially removed from our profits in the profit and loss account. Now, let's look at discount received. Discount received also. Now, if we add this back, it means we have reversed the error. But have we done the correct recording? Have we done the correct thing by posting this 280 discount received account? because it was not posted to discount to receive account. So let's post this to discount to receive account. If you post this 280 to discount to receive account, it means discount to receive account. Discount to receive account used to appear, is an item that used to appear in the profit and loss account at the credit side. And if it is there, it means it's if it is at the credit side, it means it is going to be added to our income there. So which means our income is increasing. It's increasing. So if you are going to put discount 280 inside discount receipt, it means it's going to jack up, it's going to increase our income. So discount receipt must be added back in our profits also. Discount receipt of 280. This first discount allowed 280 that we added. Don't look at it as why are we adding 280, 280, another 280. This first 280 added back is going to reverse the mistake of discount allowed that was subtracted from our profit. So it's going to reverse it. So automatically we are going to have zero. If we just stop there, we are going to have zero. It means we have not recorded the transaction at all. And we have to now put the transaction where it's supposed to be. That is inside this has received, and it's going to increase our profits, net profit, because this time is at the credit side in the profit loss account, and anything that is at the credit side of profit loss account is increasing our income. It's increasing our income. So let's look at the next one, which is number 7. Sales to James of 1236 were omitted from the books altogether. That is, it was omitted from James' account. From James' account, it was also omitted in sales account. Now, but only sales accounts we have effect in this statement of adjusted profit, because sales account used to appear in the trading account. James' account is a personal account which doesn't affect trading accounts. It does not affect trading account. It does not affect profit account. So it does not affect the issue of James itself. Does not have any effect on our reported profit. But sales was not recorded in sales. So we have to insert this figure into sales account. And if we insert it into sales account, what is the effect? Our sales figure, our sales revenue will increase. And if our sales revenue will increase, automatically our net profit will also increase. So we are adding to increase. We are putting it in it's here in order to increase our net profit. Because we said we increase the sales, we increase our net profits by adding this back also. So sales to retail. Sales omitted will be added back to increase. Will be added to increase our profits. That is 1, 2, 3, 6. 1, 2, 3, 6. And finally, number 8. The purchase of motor van of 350 at the entered in error in motor expenses account. Purchase of motor van. When motor van was purchased, it's supposed to go straight to a motor van account. And motor van account is an item that's supposed to be in the balance sheet or statement of financial position. But it was mistakenly entered in motor expenses account. But it was mistakenly entered in motor expenses account. Now, when it was entered in motor expenses account, what was the effect when it was entered in motor expenses account? Motor expenses account is an item that used to appear in the profit and loss account. And it appeared there. What was the effect? It reduced our net profit. So it has reduced our net profit mistakenly. Then we have to, when we reverse it, we add back the motor expenses, we add back the money, because it reduced our net profit there. So, and it was a mistake. We're supposed not to reduce it. So we have to add the money back. So we have to add back 350. So motor expenses must be added back, which is 350. So when we add all this back to our net profits, reported net profits, and we subtract all this from the whatever this plan gives us, then we're going to arrive at what we call adjusted net profit. We're going to arrive at what we call adjusted net profits. So I hope you all understood this. So it is just very simple. You just have to think about the effect of that error, whether the error has affected our net profit, whether the error has affected an item that we used to insert into trading account, or we used to insert into profit and loss account. So that is what we determine whether it should be added back or subtracted. And if it's an item, if it's an error that has affected an item in trading account profit and loss account, then you have to think what was the effect then. Was it reducing our net profit? If it's reduced our net profit, then we have to add it back. Or if it increased our net profit, then we have to subtract. So that is the idea behind the effect of errors on reported profits. I hope you enjoyed this and you understood this. So thank you for watching. With this we have come to the end of correction of errors, and totally we have come to the end of correction of errors. So we will show the next video. I'm going to follow the next topic, and gradually we are moving. We are going to get to the middle of the proposed topics as given in the video. So please, as I said, don't forget to like this video, share this video, and subscribe. Please subscribe to this station to assist the station. And as I used to say, you are free to assist financially any amount to support this station. And account number, as I did this also in the last video, my account number is Stanbic IBTC. Account number 00035 30 334. And I also said in some videos that I've done before that if you have a special request that you want me to quickly go to a particular topic for you, you can just message or comment or add or put your message or request into the channel. So I can quickly go to that topic and do the justice to that topic personally for you. Then you will be able to understand it. Or if you are waiting that, maybe until I said if you want to wait until when I get to that topic. So, but watch out for the next video for the next topic. So, thank you for watching. God bless you. See you soon.